Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. My guest today, he's a mobile home park owner, operator, syndicator. He's got a fund. He's been in the industry for a long time. Please help me welcome Rhett Trees. Rhett, thanks for coming on the show, man.
Oh, Ferd, I'm so excited to be here with you, man. I'm just so grateful that you spend all this time and energy to get the word out about mobile home park communities and really the good folks who are adding value to this sector. So I'm thankful for your invitation.
Well, I appreciate you coming on. Appreciate the work you do. I think a lot of our audience probably knows who you are, but in case they don't, maybe give us a little more of your background, your history, and how you've kind of started MHP and what you're working on today.
Yeah, I appreciate that. No, I've always been passionate about affordable housing. I actually grew up on a fourth generation farm in northern Indiana. My parents still live there. So affordable housing has always been something that has been a key driver for me in the real estate business. I've been incredibly blessed to have some great mentors along the way who have helped me and given me a hand up. I moved to Denver in '97. We started a hyperbolic real estate company in the early 2000s called Exclusive Resorts, which grew really quickly to about 1.4 billion in assets under management. And we sold that to Steve Case, the founder of AOL, in a couple different tranches. I was a leading sales executive there and had a blast. I actually met my wife there. And then left Exclusive after the sale. It continued on and actually left to start and take a pretty institutional view of the mobile self-storage world. So we bought 1-800-PACK-RAT from a firefighter in Raleigh-Durham. He had 3 locations at the time. There were 5 of us. We turned that into about 70 locations in a couple years and sold it to Waste Management for just shy of 100 million back the last day of 2009. And to be honest with you, I had what I call one of my spiritual revolutions where I had fallen into a deep depression at that point. I'd allowed my ego to kind of drive my self-worth, and that I was allowing myself and my ego to tell me that I was worthy by what I did and not who I was. So I took about 6 months off and I spent a lot of time on that. And I came out with a new view on the world that, my role every day is to touch someone's soul today. So I've really given a lot of my time and energy in my life to mentoring others and helping them come along, especially after I got into the mobile home park world in 2010, 2011. I bought into a private equity firm called Caddis Capital. My partner, Terry LaRue, is kind of one of the godfathers of mobile home park investing. He started the firm in '86. We had 12 mobile home park funds. The fund that he and I owned last, called Trico Fund 3, we sold to Blackstone. And Terry's in his 70s. I'm 46. So I decided to just start Seneca Capital Partners in March of 2017. I had an opportunity to work with a lot of family offices and investors over the years as a syndicator, and really wanted to start something that no one else had done, to have an institutional platform to welcome family offices and small endowments and foundations who were struggling to get access to this, unsophisticated sector of real estate. And so that's what we did. We launched Seneca as a registered investment advisor, which we're the only one that we know of in the sector. KPMG has been our auditor from inception, so we think that's a huge differentiator for us. We've got an institutional fund manager, UMB Fund Services, who's been doing all of our reporting and investor relations since inception. So we think these things are key differentiators for us to kind of bring trust and this institutional type of a thesis to the sector. So we've been really excited about it.
No, that's great stuff. So with your current fund, what is the kind of footprint you guys look for? Are you looking for deals nationwide? Are you looking for stabilized, infill, value add, combination? Obviously with the access to family offices and institutional money, I would imagine there's a plethora of investor yield requirements and investor appetites that you have access to. But how do you go about narrowing down the search, or do you not even have to, and you can have different almost divisions with different types of asset classes?
Yeah, that's a really good question. We've launched 3 funds in just shy of 4 years. So our growth pattern has been pretty incredible, and we've been really consistent through that entire period of what we call the winking smile states. So the smile starts up in Oregon, Washington, down through Idaho. We really like Idaho, Utah, Colorado, Arizona, Texas. We dip below the Gulf states and go to Florida, and then come up the Georgia, South Carolina, North Carolina coast. And the wink is Wisconsin. We actually have about an 800 pad portfolio in Wisconsin that performed better than anything else during the COVID pandemic. And then the nose of the wink is Indiana. We own some assets in Indiana, which is where I'm from.
Okay, great. And then as far as type of asset, are they mostly stabilized, or are you doing any development or redevelopment or expansion or infill? What's the strategy there?
I love that question, Ferd, because when a new broker will call you and say, tell me what your box is, and my famous response is, we don't have one. If you ask my kids what I do for a living, they'll tell you that I'm a highly paid creative problem solver. And really, if you can have that view of the mobile home park world, I think you're going to win. As you know, none of these assets are the same. I call them my children. Sometimes you've got a problem child. Sometimes you've got, an A+ kid who's the straightest arrow you've ever met. So we've got all of the above. I mean, we own as small as 17 pads and as high as nearly 400 on a single asset. So, we love this pod thesis I've been talking about since 2011. I love that a lot of people have really, started to use this in their marketing. We think that there's a huge economies of scale and more operational efficiencies on the OpEx side and on the CapEx side, to be honest with you, where we can really control our expenses at the asset level with this pod thesis. So with having 5 assets within 60 miles of each other in Wisconsin, we were able to significantly decrease the amount of humans required to run all those assets, both on the property management side and on the maintenance side. So we love to have these pods, Dallas, Houston, Raleigh, Durham, Coeur d'Alene, Idaho, Lakeland, Florida, Wisconsin, Indiana, and Indianapolis. So that's kind of how we think of the world.
No, that makes sense. I mean, I'm with you. If you can get, I'm looking at a park this morning that's right down the street from another park I own. So, you know what? I can pay more than you. I can pay more. I don't want to pay a premium, but I can afford to pay a little bit more premium because I already have a manager right there. I already have maintenance right there. It's like, you know what? There's some economies of scale, even with just a second park in the same metropolitan area. But yeah, if you get 3, 4, 5, 10, yeah, I'm sure it's. I've never had more than 3 in a single market. But I can imagine if you get 5 or 10 in a single market, it would just be excellent for those sort of efficiencies. Now, you've expanded. Obviously, you've expanded other businesses. You've expanded this business. Tell us a little bit about that scaling, that growth. I mean, I know that there's a choke point for a lot of people where it's not easy, but it's easy to go from 1 to 2, maybe 2 to 3 to 4 to 5. But at a certain point, whether it's 500 pads or 5 parks, it starts to be like, okay, now I need help. Now I need staff. And if it's in a different geographic footprint, you may need lower level staff and medium or higher level staff. And there's definitely a risk component of that from an appetite of hiring personnel. There's a risk component to trusting other people to do stuff that you've been doing. Tell us what you've learned through that process. Maybe so our listeners can follow in your footsteps some to grow the portfolio.
Yeah, I appreciate that. I just hosted a bunch of operators out in Denver for a dinner, Andrew Keel and Jeffrey Cook. And I know most of those guys have been on the program. And we have this conversation a lot, right? Because we're all just trying to figure it out. And it's amazing and interesting how different we all look at the same industry. So for us, the scale part was very important. We think scale in this business is likely the biggest differentiator you can have. So there's this void in my mind in the sector between the cobbled together guys, which there's nothing wrong with. It's a lot of work, and the institutional, kind of the 3 publicly tradeds, and then some of the sovereign private wealth firms who really want to participate but can't get enough scale. So we've been very vocal about launching 5 funds in 5 years and selling them simultaneously. Here in the 2024 to 2028 range is has really been our goal from day one. So my belief is that if you know where you're going, then the road becomes shorter, right? We're trying to pull the future forward is really all we're doing. We do believe that it's a roll up opportunity of a lifetime for us to really have a land grab and to find those assets that fit our really small niche. And so that's what we do is, if we get a 34 pad park in Jabip anywhere, it's really a quick no for us because time is our enemy. There's only four of us at our kind of corporate headquarters. So, that is something that we've been really good about, being disciplined with every asset that we see. We've looked at 258 deals, I think something like that, about $3 billion worth of deals since 2017. And I think we've purchased 15 of them maybe. So, the discipline of that purchase path is something that is helpful for us because it saves us time.
Certainly. So, and I think the rolling up or the eventual consolidation of the industry, which I think has already begun, is where people are really going to make money and you're going to get that multiple. What's your opinion on the size of the portfolio you need, whether geographically or in total, to make that real for you? Is it, can an individual get there at 5? Is it 10? Is it got to be 50? And or is it, how much of that's number of parks, dollar value, pads? What is your view of that? And I'm also interested in your view of where we are in that cycle. Are we at the maturity stage? Are we still ramping up? I mean, as an asset class.
Yeah, it's a fascinating view. I think when I started in 2011 or so, there were about 50,000 pads, 50,000 parks. And I think there's probably only about 38,000 left today because of consolidation and multifamily redevelopment mainly. So, if you look at it that way, and we think there's about 30,000 people who own just a mobile home park. So with our first two funds, we couldn't really take advantage of those, what I call perfected portfolios. So a mom and pop owner that owns between 3 and 5 parks, because our geographic exposure would have been way too high. That's what I'm excited about with our third fund. I think because it's so much bigger, we can really focus on those 3 to 5 park pad portfolios where we can go in and add a significant amount of value. A lot of those mom and pops, in my experience, that have 3 to 5 have kind of gotten over their skis a little bit regarding their personal balance sheet. So they may not have the ability or proclivity to add new homes. We have a significant storage of road ready 2017 to 2020 mobile homes that we move into our parks immediately upon acquisition, which really has been a huge differentiator for us to be able to add that much supply. That's something that gives me so much joy when I wake up every morning, is that I get to add housing stock to the lowest common denominator, what we call workforce housing, right? Where we can provide a home to a person for $40,000-$50,000 and take them out of the traditional path to home ownership and provide, financing opportunities or otherwise to get them into that home. And that's really what brings me so much joy about what we're particularly doing. We're not just buying something and sitting on it, if you will. When we have a rent increase, we do something for the tenant. We repave the roads, we add playgrounds, basketball courts, etc. So that's a big part of what we do.
No, I think that's great. I mean, I agree. It's one of the better things in the industry is to watch people. I've said it before on the show. I've had several people come up and hug me crying. I can't believe I got approved. I can't believe I get a house that's nice. And then, yeah, I mean, I think it's just strategic anyway. If you're going to put a rent increase in to add value, we like to when we buy a park. Probably going to increase the rent. We don't increase the rent the first day. We increase it like 45 days later, and we pump a ton of money into the park for the first 45 days. Like, look, we just repaved the streets. We just put in rose bushes. We just put in a playground. We trimmed all the dead trees. We demoed 5 houses. Isn't your neighborhood better? Absolutely, it's better. Do you mind paying $30 extra? It's a value, right? And I joke, like, there's some things you don't mind paying extra. I don't buy cheap toilet paper, trash bags, or razor blades, right? I'll pay for the better ones because it's worth the value. It's worth the quality. So that's what we try to do is increase the quality for the dollar instead of just squeeze dollars. And I think as an industry that makes sense. So our reputation has been up and down, mostly down for the last number of decades, and for the most part, I think it's going up on a regular basis, with perhaps a few exceptions. But I think just globally, macroeconomically asset class, it makes good economic sense and just good moral sense. Reward, give something back when you're going to not just take the extra revenue.
Yeah, agreed. I always say that, I'm a pretty spiritual cat. So, we don't want to take advantage of our tenants. They're actually, when you buy something, people forget that the cap rate is really the future value of the in-place leases that you're buying, right? So the last thing you'd want to do is to buy something and then for all those people to leave, because then your value just left with it. So, we really think of our tenants as a partner in everything that we do, which has been kind of incredibly rewarding for us, but a big differentiator for us too, that we want them to stay there. And our occupancy levels during COVID were the highest that they've ever been. And we did still have rent increases, but we were also providing tons of capex. And to your earlier point, we're doing a 25 pad development in Wisconsin right now, that was kind of already pre-done by the previous owner, and we're just really attaching the undergrounds to the trunk that's already in the back of the park and putting 25 brand new homes in. We're doing that in Coeur d'Alene also, where we're adding new homes, double wides. Indianapolis, we're doing that. So, we love these kind of small development solutions where we can add additional home and housing stock, fill the unoccupied pads with newer homes like 2017 to 2021 homes, and then run it with M. Shapiro. So your earlier question around how do we do it, how do we scale like that? At Caddis, we tried this bifurcated approach where we had an internal team that we were doing property management with, and we also had a third party team that we utilized for about half the portfolio. In my experience, we were half as proficient and twice as costly internally. Our partnership with M. Shapiro has been a game changer for us. They've committed to following us to every location we go to in the country. Their platform and people are best in breed. They are world-class at everything they do. And we feel really lucky that Mickey gave us a chance to join them as one of the handful of firms that they work with on this third-party property management side, because they see the world the same way we do, which is treat the tenant right. And really, Seneca, the founding of Seneca was built on a really simple premise: do the right thing with the right people for the right reasons. And they've completely latched onto that, and has really been a large part of our success. Did I lose you, Ferd?
Carly, this is Ferd. We had a glitch issue with recording. So Rhett was talking about M. Shapiro. So we're gonna jump back into that, and then we're gonna need these two spliced together. Rhett, are you still there with me?
Yeah. So
Okay.
I'll just dive back into the M. Shapiro story then.
Yeah, so I'll just ask you again. So Rhett, earlier we were talking about scale. Tell us how you have been able to scale with only 4 people back at headquarters.
Yeah, a big differentiator for us, Ferd, has been that we've got M. Shapiro as our dedicated third-party property manager. The blessing in my life was when I was at Caddis, we tried to do both, right? We had this, thesis that we would try to do, have an internal team that was a property management arm of Caddis, and then we had a third party that also did work for us. And in my experience, what we found was that our internal team was twice as costly and half as productive. So when we started Seneca, I really wanted to find a third-party property management partner we could be dedicated with. We originally started with Newport Pacific. We've worked with Newbie, we've worked with Sunstone, and we just, for us, found the ideal solution in M. Shapiro. They committed to doing everything with us nationwide, to investing in assets and people in all those locations in order for us to execute our pod thesis. And with them, we have been incredibly successful based on their internal resources, which I think are best in breed and world class. And we're really grateful to Mickey Shapiro for adding us as one of the handful of third-party operators that they work with. I think they own 18,000 pads in their own book. So they know what they're doing. They are very elegant at what they do on a daily, weekly, monthly basis. And Mark Kasab and his team there have just, overachieved for us.
Excellent. Yeah, I don't hear many people do third-party management. That's great, because it's definitely a hard business to manage. I generally tell people I don't think it's a real estate business. I think it's an operations business. I've done other real estate business, and this is definitely management intensive, management heavy. So if you don't have it in house, you got to definitely have a high quality team that outsource it to. So it sounds like it's working out well for you. That's great.
Yeah, I often say that property management is the most important and the least rewarding aspect of our business. So, that's been a big changer for us. When I started Seneca, I really wanted to have this dedicated team of humans that I worked with on a daily basis, and for us to go out and find these best in breed service providers like you, on the lawyer side, where we can really expedite our growth and scale quickly, utilizing these non W2 resources where we can just add humans where needed or required. And the fund administration has been huge for that with UMB Fund Services. We've got a dedicated contact there that we work with on a daily basis who's a CPA, and that's been a big rewarding experience for us too.
No, that's great. Makes sense. That's definitely something you guys can distinguish yourselves from the crowd, is having all these professional third party, not just third party like the tree guy, the road guy, the landscaping guy. No, these are third party key, some degree C-suite or VP level personnel that are available on a contract basis. So glad that's working out. That's definitely a strategy you've been able to implement. What other strategies or tips do you have for our audience that's been key to your success before you were, or maybe if you have any horror stories you want to share or lessons learned, maybe share those with our audience as well.
Yeah, we've been really successful on the acquisitions front. We've got 9 bird dogs that work for us. That's been a huge part of our business. We went to some of the brokers in the community and just said, hey, the typical buy side period can be a year long, right? By the time you get an owner who really wants to sell, you do all of your OM work, your financials, you get it to the market, you accept, and you go through your grid of potential buyers, go through a long due diligence and closing period, 105, 120 days. By the time you get done, you get to the point where you're finally done and you took your eye off the ball with other assets or other opportunities, and you gave half of it to the shop. So we went to a bunch of these guys and just said, what if you just made an introduction to us and we took everything? Well, our shop is a little bit unique in the fact that we're not a trust and verify shop, but we're a self-verification shop. So regardless of who presents what to us, we go back to the beginning and we start our entire due diligence process from scratch regardless. So it really helps to have these bird dogs, because then they can just make a quick introduction. They have the relationship. We can present ourselves to the ownership that the bird dog's going to go through the process with us. We have this kind of interweaved alliance with the bird dog, and then take down deals. And we've been having a ton of fun with that.
No, that's great. I'm with you. I jokingly say, President Reagan's one that said trust but verify. I say don't trust and verify. So it sounds like the same process. And I worked in government, and then I'm a lawyer and a broker, so I've been around liars for a long time. So I just don't trust other people very easy. Um,
Yeah, well, I mean, as you've probably run into, a couple of the deals, I think the last 5, if not 6 deals we've bought, the sellers have been in their 80s, which has been pretty fascinating. We're working with their sons or daughters who are in their 60s. We've got a deal we're working on right now that's maybe one of our best deals and maybe one of our best markets. And the owner doesn't have a computer. He's been taking rent rolls by hand for the last 25 years. So he's got a shoebox, the classic, we've all heard
yeah.
it. But we've gotten around that. We just bought a deal near a 400 pad deal
Wow.
where we just had our analysts go out and really hunker down and try and run through all the docs on site. Our COO Paul Luber's been incredible about that too. We'll take the box to the FedEx, Kinko's, and hammer through it, and then we'll try and incorporate it up into an Excel spreadsheet or some other sophisticated tool that we can use, and then present it to Freddie Mac. We do every deal with Freddie Mac. It's been an incredible part of our success too, is the support from Freddie. And so you can imagine when you present some of these, what I think of as value add deals to Freddie, they go, really? And how we've gotten around that, which is really a differentiator for us too, is that when we closed on our portfolio in Coeur d'Alene, Idaho, we escrowed $1 million of equity for that deal, in our promise to do what we said we would with Freddie. Our deal that we bought in Lakeland, Florida, we escrowed $666,000 at closing to go redo 168 parking pads that we did within about 6 months, 6-panel cement parking pads. So the investment of and in that relationship has been a big deal for us because our rates are just incredibly low. I mean, to put debt at less than 300 bips on a 10-year term, 30-year AM with 3 supplementals and the assumptive clause has been a big deal in regards to our disposition strategy, because if we're going to hold all the assets clear through a final period, we want to have a return of and a return on to our investors. So we're utilizing the supplemental tool, a cash out refinance, as a way to give back to our investors a return of capital during the hold period. So that's been a great deal for us over the years.
Now, that sounds great. I'm curious, when you mentioned earlier you'll take on even an 18 pad park, how does that fit into Freddie Mac guidelines? Is it part of the portfolio? Because that seems too low. That's below their minimums. Just curious on that. Or is that a side deal where you buy cash flow or line of credit or something?
We bought that deal in cash. It was, not a lot of money. And so we just bought that in cash. Freddie did all the other deals. That was actually an interesting transaction. And so, we only have 2 deals that we have not done Freddie Mac debt with. One is a park we own in Houston, 66 pads that we did with a local community bank, low LTV, 50 LTV. Our aspiration was to go add a ton of value to that park and then take it to Freddie Mac. We're actually going to list it for sale in the next 30 days. And to your earlier question too about private utilities, it's the only asset that we own that has well and septic. And in our experience, that's just not the ideal solution for us. With Texas Environmental Quality, we've been trying to get some previous items that the previous owner had that was attached to the private utilities, where we've cleaned them up. We've done all of that investment in that infrastructure and have now gotten it to a point where, we know that it's an asset that we can be proud of. We've repaved and put in cement curb and gutter, repaved all the roads, all new electrical. So it's like a brand new park with well and septic that have been updated. But our preference is to own city water, city sewer everywhere. We think there's about a 75 to 100 basis point free lift in private utility and public utilities. Sorry.
No, I would agree. Yeah, I usually price them about 50 bips for the sewer, 50 for the water, maybe more, a little more if it's a lagoon sewer. Give it a credit in the other direction if you got city taking care of the roads. I had a couple where the city takes care of the roads and plows those and paves them and everything. So that's not a big deal, but compared to utility system, but it's
It's
not,
huge. I mean,
it's still a relatively big deal. So anyway, great stuff, Rhett. Before we part, anything else? Otherwise, let us know where we can find you.
Yeah, no, appreciate that. Well, one other quick thing, to our earlier conversation about the creativity, right? We've got a park that we're buying right now that's a really large park that's on a lagoon system, but it's about 150 feet from the city trunk. So
Nice.
we're going about, bringing that community onto the city services, and we're going to decommission that lagoon ourselves. So that's kind of where I think the creativity and the rubber hits the road, and what's left in our world. I mean, the amount of assets that are left, I think we're all going to have a little bit of risk for that reward on some of these deals. But
no, it makes sense. I've looked at Lagoon Park. I've owned Lagoon, but I don't own it currently, but I've probably looked at 3 or 4 closely in the last year. And that's always a key point, is how close to the city services. And on one of them, it was seemingly close, but it had to go underneath an interstate. And I got an engineering bid, and it was, I don't know, 350,000, and I needed it to be 100 or something. It seemed like it might have been under 100, but I was wrong, and it was a lot more. And I was like, nope, I'm not taking that risk. It was in Illinois too, which is a little less friendly from a regulatory standpoint in general. I was like, yeah,
no,
I'm not going to roll the $400,000 dice on this one. So, but anyway, great stuff, Rhett. Tell us where we can reach out to you after this episode.
I appreciate that, Ferd. Yeah. You can check us out at senecacp.com online. I'm pretty active on LinkedIn, just under my name, Rhett, Rhett, Trees, Trees. I'd encourage anyone. I mentor a ton of up and comers in the space. I'm on the board at the Kelley School of Business, which is my alumni at Indiana University. So I mentor a ton of students there, and I'm happy to spend some time with some folks who want to learn more about the industry. We love to educate folks about what we do and why, more importantly, the why of what we do. And so they can reach me on email, rtrees, Trees, at Seneca, SENECACP.com. And my cell phone, which is the only phone I have, is 303-888-2826.
All right. Thanks again, Rhett. Appreciate it.
My pleasure, Take care.
Bye now.